Okay, let's play a little game of imagination to kick things off today.
Oh, I love these, setting the stage.
Right, so picture this. It's February 2026. We are looking back at the year that was, and you, the listener, are standing in the shoes of a legendary investor.
A very specific legendary investor.
Exactly. You manage over $1.3 billion in assets. And you've spent literally decades cultivating a very distinct reputation. People actually call you the Chinese Buffett.
Which is a heavy title to carry. I mean, it implies safety, tradition, and a very, very long time horizon.
Yeah, you built your entire empire buying the real economy. We're talking about premium liquor brands that people drink at weddings, manufacturing giants, things you can touch and hold.
The kind of portfolio that lets you sleep like a baby. Because you own the companies that have been around for 50 years, and, well, they'll probably be around for 50 more.
Right. It's the definition of a sleep well at night strategy. But then the Q4 2025 filings drop.
And everyone rushes to see what the Chinese Buffett bought.
Exactly. The financial world opens up your 13F report to see what you're up to. And you haven't just trimmed a position here or there. You have taken a flamethrower to your old strategy.
A complete teardown.
You've sold almost everything that made you famous. And you have concentrated 100% of that $1.3 billion.
All of it.
Every single penny of the reported value into just 10 holdings.
And it's not just the concentration that's shocking. It's what those 10 holdings actually are.
You are betting the house on Silicon Valley. You are leveraged to the hilt on American tech. And this is the part that I still, quite honestly, can't wrap my head around. You are actually betting against the biggest AI chip maker in the world.
All while simultaneously claiming that AI is the future of the human species.
It sounds like a total contradiction, doesn't it? Or maybe some kind of midlife crisis.
On the surface, it looks like reckless gambling.
Yeah.
But that's exactly why we're doing this deep dive today. Because when you actually peel back the layers of the Oriental Harbor Investment Master Fund...
Which is a fantastic name, by the way. Very evocative.
It really is.
Yeah.
But when you look at what Dan Bin, the man behind the fund, is actually doing, it is not madness at all.
No, not at all. Our mission today is to deconstruct this specific filing, CIK 00020463333, for the finance nerds out there.
We aren't just looking at what he bought. We need to figure out why.
Right. Why is he betting against Nvidia while being wildly bullish on AI? Why did he exit China entirely? What exactly is this rose of time philosophy he always talks about?
I think what we are seeing in these Q4 2025 filings is honestly a masterclass in adaptability. It's a case study in how to change your mind when the facts of the world change around you.
I am so excited by the all-in nature of this bet. The stakes are just astronomically high. But before we get into the actual ticker symbols, we have to start with the man himself. Because if you don't know who Dan Bin is, none of this context lands.
That's true. You have to understand his origin story.
So you called him the Chinese Buffett earlier. Is that just clever PR, or is there real substance to that comparison?
Oh, there is very real substance. But to understand it, you have to realize he wasn't born into finance. He wasn't some math prodigy at a hedge fund desk in Manhattan.
Where did he start?
He was born in 1967, and his background is incredibly blue-collar.
How blue-collar are we talking?
We are talking about a mechanic in a fertilizer plant.
A fertilizer plant. Okay, that is not Wall Street.
Not even close. Hard, physical, industrial labor. And I think that is crucial context for everything he did later in his career. He's spoken about this experience publicly.
How so?
They gave him this profound respect for the real economy. When you spend your days covered in grease, fixing machines that make fertilizer so farmers can grow food, you understand that value comes from tangible output.
It doesn't come from moving numbers around on a screen.
Exactly. It doesn't come from financial engineering. Yeah. But he was ambitious. He moved to Shenzhen in 1992.
And Shenzhen in the early 90s, that was the Wild West of Chinese capitalism.
Complete boom town. Markets were opening up. Capital was just flooding in. And like a lot of really smart, ambitious people in that hypercharged environment, he initially fell into the trap of technical analysis.
Ah, the charts, the wave.
Yes, he was obsessed with wave theory, looking for patterns, trying to predict the daily mood swings of the market. He was essentially trying to be a day trader.
Riding the momentum.
Right. And it worked until it abruptly didn't. The internet bubble burst in 2000. And that was his road to Damascus moment.
The wake-up call.
He watched prices absolutely collapse. He watched fortunes evaporate overnight. But amidst all that wreckage, he realized something profound.
What was the takeaway?
He realized that while stock prices were collapsing, the intrinsic value of the best companies remained intact. The market was manic-depressive, but the underlying businesses were real.
So the stock is not the company.
Exactly. He realized that trying to outsmart the market's mood was a fool's errand. The real money, the sustainable wealth, came from owning great businesses and letting them grow.
So he pivots from being a trader to being a true investor.
Correct. In 2004, he founded Oriental Harbor, and he did it with a mandate that sounds like it came straight from Warren Buffett in Omaha. The motto was, grow together with great enterprises.
That is pure value investing. Buy it, hold it, let it compound.
And for a long time, he lived by that strictly. His great enterprise, his absolute signature bet, was Kwaicha Mutai.
The liquor company.
Calling it a liquor company almost undersells it. It's the premier Chinese liquor brand. It is hard to overstate how important this company is culturally and economically in China.
It's the stuff they serve at state banquets, right?
Yes, it's a massive status symbol. It has incredible margins, huge pricing power. He held it through thick and thin for years. He famously called it his rose of time.
The rose of time. I saw that phrase in our source material. It sounds very poetic for a finance guy. What does he actually mean by that?
It's a beautiful metaphor for a pretty brutal reality. Dan Bin believes that time is the enemy of almost every single business on Earth.
Because eventually everyone gets disrupted.
Exactly. Over time, competitors copy your product. Technology makes your service obsolete. Consumer tastes change. Inflation eats your profit margins. Time is like erosion. It just wears everything down.
So 99% of companies are basically fighting a losing battle against the clock.
Right. But there are a very select few, the roses, where time is actually a friend. The longer they exist, the stronger they get.
The brand gets deeper.
The moat gets wider. Mutai was a rose because it had history and culture on its side. You can't replicate a 100-year-old brand overnight.
Okay, so he wants companies that are time-proof. He has a whole checklist for this, right? The 10 pillars of selection.
He does, a very strict criteria.
Right.
He looks for a sustainable competitive advantage, a deep moat. He looks for weak cyclicality.
Which means it doesn't just boom and bust with the broader economy.
Right. He wants inflation resistance.
Okay.
He wants dominant market position companies that are category kings. And he wants a crown jewel brand that creates emotional loyalty.
So that is the baseline. We have a guy who built a billion-dollar empire, finding time-proof, traditional, tangible businesses. But this brings us to the absolute shock of the Q4 2025 filing.
The great rotation.
Because if you look at his portfolio in this document, the liquor is gone. The traditional manufacturing is completely gone. He seems to have decided that the rose of time doesn't grow in a distillery anymore.
No. He has decided it grows in a server farm.
That is a massive structural pivot. Usually, value investors stay far away from tech because they say it changes too fast. They say tech has no moat because the next guy in a garage with a better algorithm just kills you. How does he square that circle?
This is where we really have to get into his carbon to silicon thesis, because this isn't just about liking a few tech stocks. Dan Bin is arguing that we are entering an entirely new era of human civilization.
He's going that big with it.
He is. He compares the shift to AI as being on par with or even greater than the Industrial Revolution.
Wow. So he views this almost like an evolutionary step.
In a way, yes. He talks about humanity moving from a carbon-based industrial model, burning stuff, to make energy, manual labor, physical goods, to a silicon-based intelligence model.
From carbon to silicon.
Right. And he believes that in this new silicon world, the companies building the intelligence layer are the only ones that actually matter.
So if you genuinely believe that if you truly believe we are upgrading the operating system of the entire human species, then buying a traditional bank or a grocery store feels like buying a buggy whip factory in 1910.
Precisely. And he applies his exact same rose of time criteria to tech giants now. He is looking for the Mutai of the Silicon Age.
But wait, let's go back to his pillars. Weak cyclicality. Tech is usually very cyclical. It's famous for boom and bust cycles.
It used to be. But Dan Bin's argument is that AI is becoming a baseline utility. If AI drives productivity and replaces expensive labor, you don't stop using it when the economy gets bad.
You actually use it more to save money.
Exactly. And regarding his pillar of inflation-resistant software is the ultimate inflation hedge. It costs almost nothing to replicate code once it's written.
That actually makes perfect sense. So he looks at the world in late 2025, sees this transition moving from the infrastructure phase to the application phase, and decides to just go all in.
And when we say all in, we really aren't exaggerating. Let's look at the sheer numbers in the filing.
Let's do it.
So as of December 31st, 2025, the fund's 13F market value is roughly $1.3115 billion.
Which is up about 14.6% from the previous quarter, right?
Right. But the concentration is the real headline here. In Q3, he had 17 holdings. In Q4, he cut that down to just 10.
And those top 10 represent what percentage of the portfolio?
100% of the reported value.
Oh.
There is no tail. There are no small experimental bets on the side. Every single dollar is concentrated into these top 10 ideas.
That takes nerves of steel. And he's churning the portfolio, too. This isn't buy and hold forever anymore.
No, the turnover rate was over 41% in a single quarter. For a guy famous for holding a liquor stock for over a decade, that is hyperactive.
He is aggressively rotating capital to where he thinks the highest efficiency is right now.
Yes, he's moving money from good ideas to best ideas with absolutely zero hesitation.
So let's get into those specific best ideas. Because if you tell me a guy is betting $1 billion on AI in 2026, I'm going to assume his biggest holding is Nvidia. They make the chips, they are the engine of the whole thing. But that is not his #1 spot.
No, it's not. And this is where the extreme nuance of his strategy really starts to shine. His #1 holding, the absolute anchor of this entire portfolio, is Alphabet, Google.
Alphabet Class C shares.
Right. He owns about 1.3 million shares. That's valued at over $405 million.
Which makes it nearly 31% of the entire portfolio, just in Google stock.
And he increased that position by over 40% in just the last quarter.
Why Google, though? I mean, they are a giant, obviously. But for the last few years, the dominant narrative has been that ChatGPT and large language models are going to kill traditional search. People were calling Google a dinosaur. Why does Dan Bin see them as the ultimate winner?
Because he sees them as the premier value play within the Magnificent Seven. Think about the moat. It is not just the search bar, it's the entire vertically integrated stack.
And the hardware up.
Exactly. They have their own custom silicon, the TPUs, so they aren't completely held hostage by chip shortages or Nvidia's pricing. They have their own foundational models with Gemini. And most importantly, they own the distribution.
YouTube, Android, and search.
Right. Billions of users. He believes the market has severely undervalued their ability to monetize AI. He's betting that AI won't kill search. He thinks AI is going to make search and YouTube infinitely more profitable by serving better answers and far better targeted ads.
He is essentially betting that incumbency wins if the incumbent has the data.
Yes. And he is so confident in this Google thesis that he isn't just buying the underlying stock. He is adding a massive turbocharger to it.
The leverage. He holds a position in something called GGLL.
Right. That is the Direction Daily GOGL Bull 2X shares.
Okay, for the listener who hasn't dabbled in the darker arts of leveraged ETFs, let's unpack that. What exactly does a 2X bull fund do?
It means the fund uses financial derivatives to amplify the daily return of Google stock. If Google goes up 1% today, this ETF goes up 2%.
And obviously, if Google goes down 1%.
The ETF goes down 2%, it cuts both ways violently.
And how much does he have in this leveraged fund?
It makes up about 2.4% of the portfolio. Which sounds small, but when you add the actual stock and the leveraged ETF together, his total exposure to Alphabet is over 33%.
Over a third of his entire fund relies on Sundar Pichai having a great year.
That is massive, massive conviction.
But now we have to talk about the elephant in the room, or maybe the dragon in the room, Nvidia.
The Nvidia paradox. This is fascinating.
Yeah, it really is, because Dan Bin says we are moving to a silicon-based civilization. Nvidia literally makes the silicon. You would think he would have half his fund in Nvidia. But instead, he has this massive position in a ticker called NVDD.
Yes. The Direction Daily NVDA Bear 1X shares.
Air. Which means he is betting against it.
It creates an inverse return. If Nvidia stock goes down 1%, NVDD goes up 1%.
And he holds $237 million of this. It's 18% of his portfolio.
It's a huge position.
Wait, let's just slow down and process this. He's the biggest AI bull in China. He thinks we are going to the stars on silicon chips. He's giving speeches about interstellar exploration and merging human and machine intelligence. And his second biggest position is a bet that the most important AI hardware company is going to drop. How does that make any logical sense?
It does make sense, but you have to stop looking at it as simple stock picking. You have to start looking at it as portfolio engineering. This isn't a bet against AI. It is high-level risk management.
Okay, explain the engineering to me.
Dan Bin knows NVIDIA is the kingmaker. He actually calls it the Muay of the Silicon Age in his writings. He respects the company deeply, but he also knows it is the most crowded trade in financial history.
Everyone owns it.
Everyone. The valuation is extreme. The expectations baked into the stock price are just sky high.
It's priced for absolute perfection. Any slight miss on earnings is a disaster.
Exactly. And because it's so central to the entire tech ecosystem, it has incredibly high beta. If the overarching AI narrative wobbles, if there is a supply chain issue in Taiwan or a new regulation or just a shift in sentiment, NVIDIA is the stock that falls the hardest and the fastest.
And if NVIDIA falls, the whole tech sector usually drags down with it.
Right. So this NVDD position is his insurance policy. It's a structural hedge. By holding this inverse ETF, He is protecting his massive long positions in Google and Microsoft.
Because if the market tanks, his Google stock drops.
But NVDD prints money. It rises proportionally to offset the losses in the rest of his portfolio.
So he is totally willing to lose money on NVDD if Nvidia keeps going up, just to sleep at night knowing he won't get wiped out if the AI hardware cycle crashes.
Exactly. It's a concept called delta neutrality. He is trying to neutralize the volatility of the hardware layer. Hardware is famously boom and bust. But he stays aggressively long on the software and application layer, which he thinks is far more stable and has much better long-term recurring value.
That is incredibly nuanced. It's not a statement of I hate NVIDIA. It's a statement of I fear NVIDIA's systemic volatility.
Precisely. It is a very sophisticated way to stay fully invested in the AI revolution without exposing yourself to a single point of failure at the semiconductor level.
Speaking of sophisticated ways to expose yourself to risk, let's talk about the leverage. We mentioned the Google 2X fund, but he has other really spicy ingredients in this portfolio. TQQQ and FNGU.
The alphabet soup of leverage. These are incredibly aggressive instruments.
For the listener who might just buy standard index funds, what is TQQQ?
TQQQ is the ProShares Ultra Pro QQQ. It is designed to deliver 3 times the daily return of the NASDAQ 100 index.
3 times. So if the NASDAQ goes up 1% today, TQQQ goes up 3%.
And if the NASDAQ crashes 10% in a week,
TQQQ crashes 30%. It is extremely volatile due to the daily reset and the volatility drag.
yes. And he has nearly 10% of his portfolio, $126 million, sitting in this triple leverage fund. In fact, he doubled his share count in Q4.
He leaned into the leverage. What about FNGU?
FNGU is similar in mechanics, but even more concentrated. It's the microsector's FNG plus 3x leveraged ETN. It tracks just a basket of the top tech giants: Meta, Apple, Amazon, Netflix, Google, with 3 times leverage. He has about 8% of his portfolio in that, though he did actually reduce his share count there by about 15% in Q4.
Rotating a bit from the concentrated FANG names to the broader NASDAQ.
Exactly.
But here is what I don't get. I have read public interviews where Dan Bin tells regular retail investors, point blank, do not use leverage, do not buy on margin, just buy good companies and hold them. Isn't he blatantly breaking his own golden rule here?
It certainly looks like a massive contradiction, very much a do as I say, not as I do situation. But I think he would argue there was a fundamental difference between a retail investor gambling on margin and a professional fund manager using these ETFs as specific allocation tools.
How so? What makes it different when he does it?
It comes back to a concept Oriental Harbor uses internally called turtle spirit.
Turtle spirit. I love that. But it usually implies slow and steady. TQQQ is not slow, and it is definitely not steady.
No, it's not. But turtle spirit in their specific corporate philosophy is about survival. It's about the hard shell. You have to remember the regulatory environment he operates in. In the Chinese private equity and fund management world, there are often very strict liquidation lines.
What does a liquidation line mean in practice?
It means if a fund's net asset value drops below a certain contractual point, say 0.8 yuan, the regulators or the fund's own bylaws might force them to liquidate immediately.
Oh, wow. So they have to sell everything at the absolute bottom and close the fund down permanently.
Right. They don't get the luxury of waiting 5 years for the market to recover. You drop below the line, you die.
So he literally cannot afford a massive drawdown.
Exactly. So he can't just hold through a 50% tech crash like a retail investor might be able to. He uses these leverage tools to manage his capital exposure hyper-efficiently.
Walk me through that logic.
He uses TQQQ to get broad, massive upside exposure to the tech sector without having to tie up all his cash picking every single winner. And because he uses less cash to get that upside, he has capital left over to buy the insurance the NVDD short to chop off the tail risk.
I see. He's engineering a portfolio that captures the upside of a raging bull market, but has a built-in kill switch for the downside via the Nvidia short.
That's it. He views himself as a highly trained pilot who knows how to handle the extreme G-forces of these instruments, whereas he views the retail investor as a passenger who might just pass out and panic sell at the bottom.
So the leverage isn't reckless aggression. It's actually a way to be capital efficient so he can afford the defensive shell of the turtle.
That is a perfect way to summarize it.
Now, you mentioned earlier that he completely cleared the decks. We've spent a lot of time on what he bought. Let's talk about what he sold, because looking at this 13F list, he really broke up with some old friends.
He did. And the biggest headline here is the absolute exit from China.
Complete exit.
In terms of this U.S. filing, yes, he sold out of Alibaba entirely.
BABA, the absolute giant of Chinese e-commerce.
Gone. Divested. 0 shares. And this used to be a core holding for him. For years, Alibaba was the premier way to play the rise of the Chinese consumer class.
Which is wild, because selling that is a huge statement for someone known as the Chinese Buffett. Why did he drop it?
He cited major structural concerns: the shifting regulatory landscape in China regarding tech platforms, the demographic headwinds. He just doesn't see the rose of time blooming there anymore. The growth story has fundamentally changed.
That is a harsh, objective assessment. But perhaps even more significant than Alibaba is his exit from TSM Taiwan Semiconductor.
Yes, zeroed out the position.
But wait, TSM literally manufactures the chips for Nvidia and Apple? If his entire thesis is that he loves the silicon era, why on earth would he sell the factory that makes the silicon?
Geopolitics, plain and simple. He prefers U.S. software and platform companies that use the chips, but don't carry the physical factory risk.
Because of the tension over Taiwan?
Exactly.
Yeah.
If there's cross-strait tension, if there's a naval blockade, or worse, TSM is ground zero. It's a massive geopolitical bullseye. Microsoft and Google, on the other hand, are sitting safe in Redmond and Mountain View.
Right. They might suffer a terrible supply chain shock, but their core assets and their software aren't physically at risk of being compromised. It's a safety play.
It is. He wants the technology without the geopolitical tail risk.
That makes a lot of sense. Now, what about the crypto stuff? I remember looking at his filings from earlier in the year, and he bought Coinbase in Q2 2025. And everyone in the media was like, oh, Dan Bin is a crypto bro now. What happened there?
Well, now, in Q4 2025, he sold every single share.
A total round trip in 6
A
months.
very quick fling. And I think this tells us a lot about his current discipline. He likely thought Coinbase might be a long-term play, maybe a structural hedge against fiat currency debasement. But clearly, something changed his mind.
The volatility got too high.
Either that, or he just decided it wasn't a crown jewel in the same way a company like Google is. When it didn't meet his rigorous standard, he cut it. He didn't let ego get in the way. He didn't fall in love with the position.
Which is incredibly hard for investors to do. When you publicly buy something, you want to be right. You want to hold it until the thesis plays out so you don't look foolish.
Not Dan Bin. If the thesis breaks, or honestly, if just a better opportunity comes along, like the AI application layer, he moves the money instantly. That 41% turnover rate we mentioned, that's exactly what this is.
It's him realizing, okay, crypto is fine, but AI is the real future. Sell the crypto, buy more Google leverage.
Exactly. Capital efficiency.
Let's look at the other survivors in the top 10. We've got Google, we've got the Nvidia short, we've got the leveraged NASDAQ ETFs. Who else actually made the cut?
It is the absolute royalty of the tech ecosystem. Microsoft, Apple, Meta, Tesla.
Tesla's an interesting one. Is he buying it because he thinks they're going to sell a lot of Model Ys?
Absolutely not. If you look at his recent writings and speeches, he views Tesla purely as a robotics and AI company. He is not looking at auto margins. He is looking at the Optimus humanoid robots, at the rollout of full self-driving.
There was that fascinating note in the research about insurance disruption, too.
Right. There is this huge angle where AI disrupts traditional sleepy industries. Dan Bin is watching companies like Tesla Insurance offering policies based on real-time, second-by-second driving data.
Which completely destroys the business model of a traditional legacy insurer.
Yes. Why would you buy insurance based on your age and zip code when Tesla can price it based on how hard you actually brake? He wants to own the disruptor, not the disrupted. Tesla is his biggest play on real-world physical AI. It makes up nearly 7% of his portfolio.
And Microsoft and Meta.
Pure application layer plays. Microsoft essentially owns the enterprise market with Copilot integration. Meta owns the global consumer attention span with their AI integration into Instagram and WhatsApp. He is building a highly curated basket of category kings.
It really is a massive bet on American tech hegemony, isn't it? I mean, think about it. For a fund based in Asia, strictly regulated, serving primarily Chinese high-net-worth investors, he is betting almost everything on American innovation.
That is the unspoken headline of this entire 13F filing. He is putting his capital exactly where he thinks the structural growth is, completely, regardless of national borders or home country bias.
He's saying the Silicon Valley ecosystem is basically the only game in town for the next decade.
Yes.
I want to circle back to this turtle spirit idea one more time, because when you look at a portfolio that is heavily leveraged on the NASDAQ, 100% concentrated in 10 tech stocks and completely out of traditional value, a turtle is just not the animal that comes to my mind. I'm picturing a cheetah or a rocket ship.
It does look like a very, very fast turtle. But again, think about the shell. The shell is the underlying risk management. The shell is the NVDD short protecting the downside.
Right.
And the shell is also the fact that he owns companies like Apple and Microsoft that have hundreds of billions of dollars in cash on their balance sheets. These are incredibly hard companies to kill.
So he is extremely aggressive on the direction he firmly believes AI is going to change the world, but he is highly defensive on the survival mechanics of the fund.
Yes, and don't forget the liquidity aspect. All of these stocks, Google, Apple, Microsoft, the QQQ derivatives, they are the most liquid financial instruments on Earth.
If he needs to sell, he can sell $100 million in a second.
Exactly. If he owned a bunch of small-cap biotech firms or illiquid private real estate, he would be completely stuck if the market turned. Being concentrated in the Magnificent Seven gives him an immediate exit door if the building catches fire. That is a massive part of the turtle strategy. You can pull your head in quickly.
That is a really great point. Liquidity is its own form of safety.
It absolutely is. And for a fund of his size, over $1.3 billion, he desperately needs that liquidity. He cannot move that much money in and out of small-cap stocks without destroying the price against himself.
So stepping back, we have this vivid picture of a man who has completely reinvented himself. From the mechanic in the fertilizer plant, to the technical chart watcher in Shenzhen, to the liquor king value investor, and now the Silicon global allocator.
It is a profound testament to cognitive adaptability. Most legendary investors learn one great trick, and they stick to it until it stops working, and then they either quietly retire or they go bust, holding on to the past.
Or they become obsolete.
But Dan Bin seems to be able to continually rewrite his own operating code.
He is updating his own mental software to match the market.
Exactly. He realized the rows of time physically moved. It used to be in Guizhou province making liquor. Now it is in Mountain View writing code. He didn't let nostalgia or his past reputation keep him chained to the old economy.
So what does this actually mean for you, the listener? Most of us aren't managing billion-dollar hedge funds. We don't have contractual liquidation lines. Should we be copying this 13F? Should we go log into our brokerage and put 100% of our retirement into 10 leveraged tech stocks?
Dan Bin himself would emphatically say no.
Really? He'd tell us to stay away.
Yes. He explicitly advises retail investors against using leverage or margin trading. He tells the public to buy broad index funds or a few crown jewel companies with cash and just sit on them.
Because we don't have the stomach for the swings.
We don't have the tools, the real-time data, or the emotional discipline to dynamically manage a portfolio with 3x leverage and inverse shorts. Most people would panic sell the exact moment Nvidia spikes or TQQQ drops 30% in a week.
So the lesson is definitely not try this exact structure at home.
Don't copy the structure, but the philosophy. That is absolutely worth stealing.
So what is the core philosophical takeaway then?
I think there are two main ones. First is concentration. We live in a world of constant information overload, and the default advice is always endless diversification. But maybe the smartest move isn't to buy 500 mediocre companies just for the sake of diversity.
Right, the index fund trap of owning a lot of garbage just to own the whole market.
Maybe the better path is to do the deep, exhausting work, find the 5 or 10 structural shifts you truly understand and believe in, and bet meaningfully on them.
Put your eggs in one basket, but watch that basket like a hawk.
If you are actually willing to watch the basket, yes. And the second takeaway is adaptability. The sheer willingness to change your mind when the facts change.
Selling Alibaba must have been emotionally difficult for him.
He had a massive history there. It made him a lot of money in the past. But the macroeconomic facts changed, so he changed. If you are holding on to an investment right now just because it used to be a good company 10 years ago, you are failing the Dan Bin test.
The rose of time eventually wilts. You have to be willing to go find the new one.
Precisely.
That is such a powerful lesson. We hold on to so many things, stocks, outdated ideas, even careers long after the structural advantage is completely gone. Dan Bin is totally ruthless about moving his capital to where the value is going to be, not where it was.
And right now, his portfolio is screaming from the rooftops that the value is exclusively in Silicon Intelligence.
Which brings me to the final thought I want to leave you with today. Dan Bin is betting $1.3 billion that we are crossing the threshold into a silicon-based civilization. He truly thinks this is a speciation event.
A new species entirely.
Right. And if he is right, then looking at traditional price-to-earnings ratios of companies like Nvidia or Google is almost entirely irrelevant because they aren't just software companies, they are the literal architects of the new world.
But
if the AI bubble is just noise, if these large language models hit a wall and it turns out to just be a really advanced spell checker and a better way to generate emails, then a portfolio this concentrated and this leveraged has absolutely nowhere to hide.
it is entirely binary. Either he goes down in history as the visionary allocator of the century, or he's going to hit that 0.8 yuan liquidation line incredibly hard.
So when you look at your own portfolio tomorrow, ask yourself, are you watching the Magnificent Seven just as a group of hot tech stocks, or are you watching them as the architects of a new species? That is the exact question Dan Ben is asking with his capital.
And his money says they are the architects.
Thanks for joining us on this deep dive. We will absolutely be watching those Q1 2026 filings very, very closely to see how this incredible bet plays out.
I honestly can't wait to see the next move.
See y'all next time.